The big news over the weekend was the passage on July 4th of President Trump's Big Beautiful Bill. It was an important week for tariff news. President Trump threatened 14 countries, including Japan and South Korea, with stiff tariffs unless they reach trade deals. Over the weekend, Elon Musk went back to fighting with President Trump and announced that he was creating a third party. We're going to do something a bit different this week. Dan is here to talk about what's in the bill.
Anytime you do something in Congress that's 1,000 pages or so, you're going to have investment implications.
You got to say that again, because that's unheard of. Hi, this is Steve Eisman, and welcome to another edition of the Weekly Wrap. We're going to do something a bit different this week. The big news over the weekend was the passage on July 4th of President Trump's Big Beautiful Bill. This new legislation is so big and detailed that on Wednesday, I recorded an interview with Dan Clifton, the political analyst at Strategas. Dan was my first guest, and when we talked in early April, we discussed tariffs. On Wednesday, we talked the Big Beautiful Bill, which is now law. We will cut to that interview right after I finish the normal weekly wrap. And first, the stats. For the week ending July 11th, the S&P and NASDAQ were down a tiny amount. The market ended the week just a touch below all-time highs. For the year, both the S&P and NASDAQ are up around 7%. It was an important week for tariff news. At the beginning of the week, President Trump reset the deadline to reach trade results from July 9 to August 1. Any country not reaching a deal by then will have the April 2 tariffs reimposed. And on Monday, President Trump threatened 14 countries, including Japan and South Korea, with stiff tariffs unless they reach trade deals. And then there was more. President Trump announced a 50% tariff on copper imports, causing a record spike in New York copper futures. And later that day, on Wednesday, he announced tariffs on Algeria, Libya, Iraq, and Sri Lanka, and the Philippines if they don't reach deals. And by the end of Wednesday, President Trump also threatened Brazil with 50% tariffs. And on Thursday, President Trump threatened 35% tariffs on Canada and threatened even higher tariffs if Canada retaliates. It's a busy week in tariffs. By the way, the market did not react at all to this series of tariff news. In fact, the market reached an all-time high Thursday, and the market barely reacted negatively on Friday on the Canada news. In other news, there was an interesting tidbit in private equity world that shows how big private equity has become. Apparently, Goldman Sachs plans to ask junior bankers to confirm their loyalty on a regular basis to limit poaching from talent-hungry private equity firms. New analysts will be asked to certify every 3 months that they have not accepted jobs elsewhere. I thought that was kind of interesting. Over the weekend, Elon Musk went back to fighting with President Trump and announced that he was creating a third party. His shareholders did not like that, and the stock continued to slide. Tesla's shares are down over 20% this year, and the market cap is now back to below $1 trillion. And that's the news for the week. Other than tariff news, it was a relatively light week. Next week, earnings season begins with the big banks. I expect the results to be quite uneventful, but I do expect strong trading results at the large banks. And now, the mailbag. We have 3 pieces of mail this week, and I'll try and go through them fairly quickly so we can get to the Dan Clifton interview. The first is from Maine777, who says some nice things about our podcast, and then he has 2 questions. First, he asks, if you were interested in hedging against a downturn in the U.S. beyond short-term bonds and large-cap undervalued U.S. stocks, what else would you look to? Any countries in particular, and why? Second, if you were interested in a sector that is under the radar and has a probability of explosive growth in the next 10 years, what would that be? So first of all, I don't look outside the U.S. That's just me. As far as hedging is concerned, if you really want to hedge, I think the only thing you could do is buy out-of-the-money puts on the S&P or NASDAQ. But I'm long-term bullish, so I'm not advocating this. The benefits of buying out-of-the-money puts is that if you're still positive on the market and the market goes up, you will make money on your portfolio and you'll just lose the premium you paid for the puts. As far as under-the-radar groups, right now the only underperforming groups are all defensive, like staples. But since I'm long-term bullish, they don't really interest me, and I don't have anything right now that I think is out there in terms of a subsector that is overlooked. But when I do, I'll be back. Second piece of mail is from David G., who writes, I'm a fan and watch your podcast, and he has some other nice things to say. His question is this. He says, the rally in the stock market over the last 3 weeks has been something short of unbelievable, except for the fact that it did happen, where the market went up virtually every day, but also had virtually no pullbacks overnight or intraday. He's 100% right on that. To me, it seemed like an unnatural movement of the ebb and flow of market dynamics and movements. Question is, do you think the market is manipulated by either some government agency or Wall Street market makers, etc., to help explain this manic movement of late? This latest move seems to be completely unnatural, and wanted to see what your insight was, or perhaps I am a dinosaur and market pullbacks are a thing of the past. Well, first of all, I don't think market pullbacks are a thing of the past, and I don't think you're a dinosaur. I don't think there's some conspiracy theory, some government agency out there that is trying to manipulate the equity markets. If that were true, I'm quite convinced that it would have leaked by now. Now, if you go back several years, the Federal Reserve did do something called quantitative easing, where they bought a whole bunch of fixed income products to try and improve the US economy, but that was done publicly. To me, there's no conspiracy here. And I actually think the best conspiracies, the most important conspiracies, are the ones that are unspoken, the ones that develop over time, like in the 2000s, lending to the middle class and lower middle class at exorbitant rates, and that becomes the ethos of the sector of Wall Street. So I don't think there's a blatant conspiracy going on here, and I wouldn't really be concerned about it. And the last question is from Stephen Smith. He says, I really appreciate your commentary, particularly how idiot-friendly your explanations are. You're welcome. As I'm not particularly knowledgeable about markets beyond the wisdom, I hope you can forgive my generosity that I get on YouTube and the talking heads I hear on CNBC. I think that at a surface level, I understand the implications of what I'm about to describe, but it's only a shallow surface understanding. Can you tell us about the implications of all the money that is sitting around in money market funds right now? And specifically, I would ask in your answer to describe what is a money market fund? So that's an excellent question. A money market fund is what I would call a substitute for putting your money in the bank. If you put your money in the bank in the form of a checking or savings account, up to a certain amount, you have FDIC insurance. And if the bank goes down, you get paid 100 cents on the dollar. But if you put your money in a money market fund, you are not guaranteed by the FDIC. And generally, you will get slightly higher interest than you would get by putting your money in a bank. Now, pre-financial crisis, there were lots of different kinds of money market funds. There still are. And some of them were in very risky short-term stuff that they advertised as being not risky, and it all blew up in the financial crisis. So if I were putting money in a money market fund, and sometimes I do, I would make sure that that money market fund only invests in short-term U.S. treasuries. This way, you don't have FDIC insurance, but you have basically the same thing because what you're buying is debt of the United States government. And that's the wrap. Before we cut to my interview with Dan Clifton, I just want to add that I read all the comments. The easiest way to make a comment is on YouTube or directly to me at info@steveeisman.com. My goal in this podcast is to educate. If you're finding insights that you're not getting elsewhere, I would ask that you subscribe to my YouTube channel here and to subscribe to my newsletter on my website, because we will soon be releasing several financial literacy lectures on a multiplicity of topics that I think many of you will find interesting. Since earnings season starts next week, we are dropping a podcast on Monday where I interview Chris Ferrone, the market strategist of Strategas. I always think it's a good idea to review market trends before we begin the enormous data dump that earnings season brings. Thanks for watching, and see you next week. And now, my interview with Dan Clifton. Hi, this is Steve Eisman, and this is a special edition of the weekly edition of the Weekly Wrap. And my guest today is Dan Clifton of Strategas, who is the political analyst. We are recording on Wednesday, 2 days before the end of the week. Dan was my very, very, very first guest, and he is back. And the reason he's back is over the weekend, when President Trump signed the bill, I realized that for the Weekly Wrap, I needed to do something about what's in the bill. And I thought, well, I could do it, or I could bring in somebody who really knows what they're talking about. and that's Dan. So Dan is here to talk about what's in the bill. And let me just lay some groundwork here. President Trump can be a very polarizing figure to a lot of people. But in the business world, we don't call the game. We just take the pitches and try and figure out what to do about that in terms of business perspective. Dan and I are not here to tell you to vote Democratic or Republican. We are not here to tell you the bill is the greatest thing in the world. We're not here to tell you it's the worst thing in the world. We're just here to tell you the bill just became law. Let's talk about the ramifications. So Dan, take it away. Give us a summary of the major points of this 981-page bill, and then I'll ask you some questions.
Great. Well, first, thank you for having me. And anytime you do something in Congress that's 1,000 pages or so, you're going to have investment implications from that type of legislation. And we have 5 major categories that we would put, or 5 themes that we would put into this one big beautiful bill, as they call it. Number 1 is that it makes all of the expiring individual tax cuts that were going to expire at the end of 2025, those tax cuts have now been extended, and they are extended permanently. So what that means is that there's going to be no fiscal cliff at the end of this year. Businesses don't have to worry about the uncertainty in the second half of the year. As long as I've been doing this, Congress always waits to that last minute, and they didn't do that. So income tax rates are staying the same. The child tax credit is now locked in, but it's going to be raised up to $2,200 per child. The estate tax is $15 million. The alternative minimum tax is patched. That is by itself a major victory, because we would have had a $400 billion tax increase on January 1st, and that's no longer going to happen. So that's number 1. Number 2 is that the president got his presidential priorities through. What were those priorities? Well, number 1, less taxes on tips, less taxes on overtime, less taxes on seniors, and no taxes on auto loan payments.
Which is what he promised.
He promised it. He's now delivered it. Okay. And I'm not a big fan of that. I'd rather just lower income tax rates and spread it out to everybody.
But you didn't run for president.
But exactly. He got 75 million votes, and I got
and you did not.
Exactly, right? So look, that's $80 billion of consumer aid that's going to come out in February, March, and April of next year when people file their taxes. And on those permanent extensions, there's some plus-ups on there. So you're looking at over $100 billion of consumer aid at the end of first quarter, early second quarter next year. And I think that's good, because the economy slows, you get a reload. If the economy doesn't slow, you get kind of an acceleration. So that's going to be very important. And then third is what I call the tariff sterilization. Think about that first podcast you and I did on the morning of April 3rd. Markets were in upheaval. And our whole point was these tariffs have to be sterilized. This is going to be a recession. And the business tax cuts are the way they do it. There's 4.
So in other words, if they were just tariffs, that could possibly cause a recession. Absolutely. But you have the tax cuts, so it offsets the increase in prices of the tariff.
Absolutely, right? So the way they do this is they say, okay, number 1, if you build a factory in America, you get to write that off 100%. We've never done that.
You got to say that again, because it's unheard of.
If you build a factory in America, you can write it off 100%.
So in other words, if it costs me $1 billion to build a new factory in Ohio, it's like, are you saying that I get to write $1 billion off my taxes?
When you do the actual expensing of that, you're basically getting it for 30% cheaper by being able to do it, right? So you're expensing it. And so if you have a higher tariff cost and those projects are cost prohibitive, you've completely eliminated that kind of tariff effect by writing this down. These properties have a 30-year life cycle that you're depreciating over time, the amortization. You're saying, no, you get to write it off now, so that time value of money gets to help. So all data centers, factories, we think LNG export terminals. So we're probably going to have a building boom in America from that provision alone. Then if you want to buy a capped good order, then what would happen is that you get to write off 100% of those capped good orders immediately, which is called 100% expensing. And I think that's really important. And by the way, that's permanent. So that's not like, hey, you got 3 years, 4 years. It's going to be permanent in the structure. And when you do that, that feeds right into non-residential CapEx, so fixed investments. So you'll see it translate right into GDP. And John Deere and Caterpillar, they're going to have their salespeople out with sheets saying, hey, if you buy this tractor right now, you get to write it off immediately off your taxes. pretty important, right?
That's
Number
huge.
three, I think, is really critical because I know we're going to talk about healthcare and the impact of healthcare. There's something in there called R&D expensing. So your research and development costs are also going to be expensed if that research and development happens here in America. It is very important for like med tech and pharma and biotech that are going to be included in this bill. And so now think about this, right? If you sell the good, you get the sale and the earnings. But if you actually buy the good, you get to write it off your taxes. So there's going to be two different types of winners around these provisions. And then the fourth, which is less growthy, but important for like utilities, is that what would happen is that you can deduct more of your corporate interest off your taxes. Right now, it's a very strict standard, 30% of EBIT. It would go to 30% of EBITDA, becomes a little bit more generous overall. So those are the four business growth provisions. Okay, so that's the fun stuff. We just did three themes that are candy. There's obviously got to be spinach, because what this bill does is it cuts taxes by $4.5 trillion, but it cuts spending also by $1.5 trillion. And the four major areas that they cut spending are renewable energy through the IRA. Those cuts are over $500 billion. Then you have Medicaid cuts. Those Medicaid cuts are $1 trillion over 10 years. When I say cuts, they're actually slowing the growth of Medicaid spending. So Medicaid spending is going to continue to grow, but it's going to grow at a slower rate. They also make changes to food stamps, which has very important impact on consumer staples. And then fourth is that they do massive student loan reorganization. Not as big as the House, but still pretty significant. And they get like $350 billion of savings out of student loan programs by
What do you
getting
mean
rid of some of the government
reorganization?
programs that don't work. So that's the spinach that goes along with the candy. It's pretty big.
Dan, can I interrupt you one second? When you said there's student loan reorganization,
Yeah.
I don't know what that means. What does that mean?
So clamping down on President Biden's SAVE program and income forgiveness, changing the Graduate Loan Plus program, which is very important because there's a high default rate on those Graduate Loan Plus programs. And so it costs the government money. And it's like, we're going to get rid of these programs and they're going to save money. Now, they make up for that somewhere else by allowing higher loan limits and professional degrees for doctors and lawyers and things like that. But at the end of the day, Sally Mae is looking at that going, hey, is there going to be an opportunity here if the government is getting less into these types of programs? So you're moving it more into a privatization mode. And then the fifth is that we raised the debt ceiling by $5 trillion. So the debt ceiling went up as soon as the president signed this bill, and Treasury Secretary Bessent can now issue debt. He made a very important statement yesterday out of the Treasury Department that they're going to take their time refilling the Treasury General Account, which is how the government pays its bills, so that they don't have to put a lot of debt on the market almost immediately. He's going to spread that out. And I think it's made the fixed income markets a little bit calmer in relation to how much issuance we're going to need in the short run over this debt ceiling. So those are the five big themes of what's in one big beautiful bill. And obviously, as you get into the specifics of those programs, it's pretty wide ranging and has significant investment implications.
So, well, we could talk about this for hours, obviously,
absolutely.
and we're not going to talk about it for hours. So let's just focus on some real key points. Let's just focus first on the deficit.
Yeah.
You know, you open the newspaper, people are screaming and yelling. Larry Summers is screaming and yelling.
Yep.
The deficit's exploded. What has actually happened? What is the CBO saying? And what growth assumptions are we talking about here?
Yeah, so the first thing is the U.S. deficit is high. It's 6% of GDP or 6.4% of GDP. It should be closer to 3% of GDP. What this bill does is it doesn't increase the deficit as a percentage of the economy, but it doesn't make it worse. So if you look at the Moody's downgrade of the United States, it says that we're going to 9% of GDP deficits because of this bill. And that's not the case of what's going to happen, largely because, number one, we have some offsets in there. And number two is that you have all these tariffs that are happening side by side that are not being counted in the bill. And so the Congressional Budget Office says that one big beautiful bill will increase the deficit by $3.4 trillion over the next 10 years. The CBO also says that Trump's tariffs are going to raise $2.8 trillion over 10 years. So it almost pays for that whole deficit gap. And what you've seen since one big beautiful bill passed is that the president's basically put in another $600 billion of tariffs through Vietnam and through some of these others. He's basically bridged that gap overall. And so if you look at just the tariffs and say they're raising all this revenue, or you look at the tax bill and say it's increasing the deficit, talking about them individually is not correct. But being able to look at the two factors together and saying, what does the outlook look like? And what it shows you is that the deficit's going to stay somewhere around 6.2, 6.3% of GDP. Very different than what I read in the mainstream media about blowing out deficits, and very different than what I read in some of the MAGA, type of stuff about how the deficit is not a problem. It's basically status quo from here. But you got a lot of these tax cuts extended. And the one thing that I would just say about this, Steve, which is really important, is that this is the first time that we're in austerity in 30 years. Austerity comes to America when your interest cost goes up really high. And we have a very high interest cost relative to our tax revenue that we're bringing in. Right now, we're about 18%. Usually, once you get over about 14%, that's where you see austerity kick in. And so it just becomes harder to do. And think about what we just did. We just extended existing tax cuts that people got this year so that they can have it next year. And we did it by bringing in more tariffs. And that's austerity, in my opinion, and why I'm less worried about the deficit. But the larger takeaway is that we are basically moving into budget trench warfare, where we're going to have to be dealing with these fiscal issues year after year after year because this bill doesn't make it better.
Let's just focus on two more things. So the Medicaid growth slows, but let's just look healthcare generally. What are the major implications for health insurance companies and pharmaceutical companies from this bill?
Yeah, let's just take pharmaceutical companies first, because I think they're really interesting what's happening on the pharma side. Pharma and biotech stocks have just gotten eviscerated this year. And so what you saw was the president was threatening price controls through what's called most favored nation, getting a drug price that's similar to what they charge outside the United States. And two, by putting tariffs on the pharmaceutical industry at a 25% rate. What the president said yesterday, separate from all this bill, is that he's not going to put those tariffs in for a year or 18 months because he wants to see how many companies move to America now that they got 100% expensing of factories. This is what I'm talking about when I say this is really big, right? So 100% factory expensing may affect the pharmaceutical industry. And I'm not sure that's like really the way people are thinking about it, but that's what's happening. That's number one. Number two, this bill says that if you have two orphan drugs, you will not be, two or more, you will not be subject to Inflation Reduction Act price controls that were put into effect in 2022. That's like really important for some of these drug companies, right? So a very unexpected last minute win for the drug companies. And third, those drug companies get the R&D expensing on research and development. So like Amgen and Vertex, they had all been lobbying for that. So from my vantage point, what I see happening is pharma is just getting a lot more interesting to us after a massive derating of the sector overall. And I think this bill helps in that area.
Yeah. Let me ask you a question that just occurred to me from what you were saying. Let's say I am pharma company A.
Yep.
And I don't have two orphan drug companies, but I'm a big company.
Yep.
Could this cause me to go buy some biotech company that has two orphan drugs? And so now all of a sudden I got two orphan drugs. And so all the stuff that I was going to get in the whole pricing thing, I'm no longer in it?
So you were, but it's for those drugs specifically. And
just for those drugs.
And previously it was just one, but a lot of them have like 2, 3, 4 that were going to get hit. And this bill says, nope, we're not going to hit those. So you're excluded completely.
I see. Okay.
And I mean, like if you look at what Vertex is doing on cystic fibrosis and in some of these other areas and stuff, they're basically saying the price controls can limit innovation where we need the research in these more isolated areas, which are kind of harder to get remedies and cures for. So that's the rationale behind it. And I think that's interesting to me, right? Just because the stocks are down a lot, policy has gotten a little bit more creative for them. They still have some headwinds in front of them, but things have gotten better because of the bill, and it was unexpected. Okay, so very different story for Medicaid. Because what's happened is that Medicaid has become one of the fastest growing parts of the budget. Medicaid's not good healthcare. It's never been good healthcare. It's always been kind of emergency type of healthcare. Good healthcare is ACA healthcare, Affordable Care Act healthcare. And so what happened was when the pandemic came, Medicaid just surged up. and grew about 20% growth rate. A lot of people were on it. The states have now been kind of paring down those rolls. And even with the states paring down the rolls, the Congressional Budget Office in January updated its forecast for Medicaid by $800 billion over 10 years with no real major changes. Massive number. And so I think the way to conceptually think about this bill is that Congress just came in and said, we're going to make policy changes to wipe out that $800 billion cost increase that just happened in the January budget. And they do that by more work requirements. So if you're able-bodied and you can work and you want Medicaid, you got to go to work. And number two, income verification. So if you get income verified twice a year, you save over $100 billion by doing that, because people will get income verified and then go to work, collect more money, and still get their Medicaid, right? So they're clamping down. That's why when they talk about waste, fraud, and abuse, but it's not insignificant. It was like $250 billion. The big issue is what happens on how states finance Medicaid. And what they do is they raise taxes. And when they raise taxes, they put more money in the Medicaid system, and then that triggers more federal Medicaid money. So Congress is like, whoa, we got to clamp down on these tax increases at the state level. And so the House basically just put a cap at the current level around 6%. The Senate went way further. They said, no, we're going to 3.5. We're going down to 3.5. And so that will cause some pain for the states. There are two ways around this. Number one is that it doesn't kick in until 2028. So if you read the newspaper and all these Medicaid cuts are coming now, and they're not. It's not going to happen until 2028. By the way, that's a presidential election year. And, as we talked about on your last podcast, AOC is going to be probably running for president, going, we shouldn't be cutting Medicaid, right? And by the way, there's a lot of Republicans that don't want to cut Medicaid. And number two is that they built this kind of rural stabilization fund for hospitals. And it's pretty big. It's like $100 billion. So that if the hospitals come under strain, there's this kind of emergency fund there for them. So I thought those were like important changes that over time we'll start to see a more rational discussion about what's going on in healthcare. But if you remember during Obamacare, everybody's like, everybody's healthcare is going to go terrible in 2009, 10, 11, but it didn't kick in until 2013, right? And so nothing happened. And I think we're going to be faced with a similar situation. Every problem in healthcare will be blamed on this bill, but the actual cuts and changes don't come into effect till 2028.
Okay, so let's turn to the last issue, which is this writing off of all equipment.
Yep.
And writing off all the costs of building a factory in the United States is pretty revolutionary when you think about it.
Yep.
Who in your house's view benefits from this?
Yeah.
And what are the expectations of what this is going to mean, and what companies benefit?
Yeah. So first thing is, my experience with these provisions is we have a very good understanding of who wants this. What will happen is once the bill passes, every company will now get a copy of a summary of the law, and they'll go, oh, you mean if I buy this, I get it free, or I build this, I get it free? There are going to be more and more companies over time that maybe have not engaged in this, now see that the economics work for them to engage in it. So based on what we know, is that number one, industrial companies really benefit from these changes. And we know that because there's 100% expensing coalition that's out there. And, that's FedEx and UPS and Lockheed Martin and Boeing and companies that do large investments and companies that do large buying. And so it's pretty broad in industrials. It's materials that benefit from it. And those are going to be the big winners. And what's interesting is that we had a temporary 100% expensing of cap good orders in for 2017 to 2022. And our basket of these companies began to underperform as soon as that 100% went away. So we went from 100% to 80% to 60% to 40%. It continued to underperform. So we think our basket of these cap good order companies that are going to get increased sales are really going to take off. By the way, there's tech companies that benefit because software is included in the definiation.
Oh, really?
Okay. Software companies are going to get all these sales from that, right? And so, like companies like Autodesk lobby for this, and it can get very specific. And I think the bottom-up analysts are going to have a field day with the potential options on this. Number two is on the R&D. It is much broader. This is tech companies. This is the big, magnificent 7 companies that love that R&D expensing. It's healthcare companies and it's industrials and material companies overall, right? So it's a much broader set of list of companies. And then anybody who builds factories, companies that are investing in factories, this is going to be a really big growth area, I think, on the commercial real estate side. And by the way, we may end up with a whole bunch of ghost factories where nobody works in them, but they're going to build them, and we're going to ride that wave while they're building them.
So do you think, I'll just make up a silly number. Like let's say I assumed that in 2026 and 27, my assumption was that the U.S. economy was going to grow 1.5%. I just made that number up. Given this change, how much do you think that this might be able to add to GDP growth?
I think it's going to add 1% to GDP growth. So
100 basis points to GDP growth.
100 basis points to GDP growth.
Wow.
And I think it's very front loaded. The business stuff is retroactive to January 1st this year. Mm-hmm. So we're already seeing companies paying less in corporate taxes because they already know that they're gearing up for this. So I think it might take a while for them to kind of ramp up into 4th Q, 1Q, and then you get the consumer aid. But you get a full percentage point on this, and it will be a 2025, 2026 story. Just as the IRA and the infrastructure money, it's still growing, but it's growing less. This becomes that sort of replacement for that. Very interesting to us, right? So that's number one. But you have to remember that Trump's tariffs are subtracting growth right now, and they're slowing the economy. And so we always view this more as a sterilization than a growth package, because what Trump put out on April 2nd was pretty bad. We got up to about $700 billion in tariffs. Today, we're at $330. And what Bissett was doing, to his credit, was he was basically delaying out the tariffs to allow fiscal policy to come in and sterilize and get a better sequencing. And I think that's the biggest takeaway from this legislation, is that we have a much more optimal policy mix today than what we had, 3 or 4 months ago, which was a pretty bad policy mix.
That's great, Dan. Thank you. That's really helpful, and learned a lot. I appreciate you joining us today.
Thank you for having me, and best of luck.
Thank you.
This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.